Hey everybody. In my previous video, I showed you how to make journal entries from transactions. So here's all the transactions and here's the journal entries we made. So now I just want to show you how to post those journal entries to a ledger. And in this video, I'm actually going to show you two different styles of ledgers you might see when you're doing your work. The first, I guess, is a more traditional ledger where we have our transactions and then the debit credit of the actual transaction, and then the balance. And we do that for each account. So in a journal entry, we were doing the entering our information in chronologically. Each time there was a transaction, we recorded the account that was impacted and the debit or credit for that account. And if you'll remember, we had two accounts impacted for each one. Sorry, I had those highlighted because I was making sure I had all of them for you. I'm going to unhighlight them now. All right. Um, when we move from a journal to a ledger, you'll notice a ledger isn't listed like in order of transaction, it's listed by account. So the ledger lets us write down our account. I mean the transactions that impact each account, so that we can then find a balance for the account. And so these traditional style ledgers is where I'll start. In real life, and you might have a transaction number, but you'll also often have a date. Not often, you always have a date. But for these practice transactions, we don't have a date. So we're just going to use the transaction number. So all we do to record the journals entries over to a ledger is we look at what accounts are impacted and how they're impacted. So I'm going to say the cash account in transaction one had a debit of 10,000, and the common stock account in transaction one had a credit of 10,000. And then once we've entered those, then we can do our balance. So since this account had a zero balance before and we debited the cash account 10,000, the balance is now a debit of 10,000. And for the common stock account, it had a zero balance before. We credited 10,000, so now it'll have a balance, a credit balance of 10,000. And that's it really. So we'll go to the second one. We debited office equipment 3,000. So I'll find my office equipment account. Transaction two, we debit that account 3,000 and we credit cash 3,000. So on transaction two, we credit cash 3,000. And now we find our balances. If it had a debit balance of 10,000 and we credited the account 3,000, we'll now have a new credit balance of 7,000. Oh, I'm sorry, not credit. My mistake. A debit balance of 7,000. So whenever we're figuring out the balances, we'll take the previous balance. If it was a debit, and then we're doing a credit entry, that will reduce the debit by the amount of the credit. If it had a debit balance and we did a debit entry, we would add the two together to find the new debit balance. And then on our office equipment, it had a balance of zero. We debited 3,000, so the new balance will be a debit of 3,000. Transaction three, we debit cash 5,000 and we credit notes payable 5,000. And now we find our balances. So if we had a debit balance of 7,000 and we debited the account 5,000, 7,000 plus 5,000, the new balance is 12,000. And then for the accounts payable, I'm sorry, for the notes payable, we had a zero balance. We credited 5,000. So the new credit will be 5,000. New balance of the will be a credit of 5,000. Transaction four, cash is debited 1,500 and service revenue is credited 1,500. So the balance of that revenue account will be a credit balance of 1,500, and the balance of our cash account, if it was 12,000 plus 1,500, gives us 13,500. Transaction five, rent expense and cash. So we're going to debit rent expense I forgot how much it was. 1,200, giving us a new balance of 1,200. And we're going to credit cash 1,200. So in this case, we're going to take 13,500 minus 1,200 is going to give us 12,300 as the new debit balance. Whoops, 12,300. Transaction 6, we debit office supplies by 500, giving us a new balance of 500. And we're going to credit accounts payable by, what was it? There it is, 500, giving us a new credit balance of 500 in that account. Transaction 7, we're going to debit utilities expense 300. Which gives us a balance now of a debit of 300. And we're going to credit cash 300. Which will now give us a debit balance of 12,000. Right? We had 12,003 minus 300. Transaction 8, we're going to debit cash 200. And we're going to credit accounts receivable 200. And so we don't know if we had a balance here. So it's unusual. Normally you would have a debit balance on accounts receivable, but not knowing ahead, we're gonna say right now we have a credit balance of 200. If we had 12,000 in cash plus a debit of 200, we now have 12,200. Transaction 9 will debit cash 2,000, and that'll give us a balance of 14,200, and then we'll credit loan receivable 2,000. And again, with those receivables, we're assuming we had some sort of a balance before, but we don't have that information. So as of right now, we're going to say we have a credit balance of 2,000. Finally, on number 10, we'll debit retained earnings 500. And which will give us a balance of 500 in the retained earnings, a debit balance of 500 in the retained earnings account. And we'll credit cash 500. So 14,200 minus 500 will give us a debit balance of 13,700. And there we go. So that's transferring all of these journal entries over to the ledger, which now allows us to have a balance by account. For most of these, it was easy because there was only one transaction affecting each account. But on cash, you can see we had lots of debits and credits changing the balance of the account. I hope that helps. I'll do a separate video that shows us how to do the same thing, but using the T account style ledger, so you can see that if it's helpful to you.